Hi, everybody. Welcome to another episode of the 7 and 7 Show with Zack Ellison. Today, I have with me Samantha Lewis, a partner at Mercury Fund. And Sam, thanks for joining.
Yeah, of course.
Very happy to have you here. And so tell us how you got here. How did you become a VC and how did you get here today?
Well, going back to the very beginning without boring everyone, I come from a family of entrepreneurs. So both my mom and my dad have started companies, and all of the companies they started were actual real businesses. And you'll see what I mean by real businesses later, but they actually cash flow, they actually have positive EBITDA, et cetera, et cetera. And so I grew up in a family just seeing that. And then went to college at Texas A&M University here in Texas, and then started a few companies. Actually, one of them was with my mom, and it was in food logistics and supply chain. We grew that fairly quickly to about $3 million in revenue over a few years. And then I started another company modeled after the Dry Bar, which most guys don't know what that is, but all the women do. It's a place where you go and it's very simple, where you just get your hair blown out for events or for days. And it's a really, really simple model. So we built something like that for lash extensions. So I did that. And then I sold that business and then went back to business school. And when I went to business school, I went to Rice University here in Houston. And I really thought about how can I apply what I've learned in my entrepreneurial journey to scalable tech startups. And so I got really involved with everything, like all things tech entrepreneurship and VC, to really dig in and understand. I actually met my now partners at Mercury Fund, Blair Grew and Aziz Galani, as in one of their classes that they teach at Rice. So they teach a venture capital class. And I met them then, and then they mentored me throughout the years. After Rice, I jumped over to investing straight after I graduated, was doing early stage investing in deep tech startups for about 3.5 years, and then jumped over to Mercury in 2020. And so Mercury is an early stage investment firm that's focused on software, and it's outside of the coastal hubs. So we'll get to this a lot more, Zach, as we're thinking about how we think about the world of venture. And it's quite different from how my friends and my colleagues on the coast think about venture. There's not necessarily one right or wrong, but both of them are important to drive returns. And so we believe we have a pretty good model for that here in Texas.
So you were an operator and business builder before you became a VC. How has that helped you as a VC?
Yeah, I think on the qualitative front, and I know I've already told you this before, Zach, but I really try to think about my role as a VC, not only from the quantitative metrics and the things we'll talk about, like that can help me drive quantitative outcomes, but so many people overlook the qualitative pieces of how hard it is to build a startup. So you'll see throughout our conversations and throughout the podcast today that I try to think a lot about inserting qualitative pieces into it, just because that matters a lot, and especially in early stage venture. Like sometimes we're investing in companies that are $1 million of ARR. Like they have so far to go before they can only be driven by quant metrics. It's the entrepreneurial journey. We think about this a lot at Mercury. And so when we're thinking about hiring new people, when we're thinking about elevating people to partner, or we're thinking about bringing on LPs, or who we're investing in as startups or partners across the Mercury platform, we have really identified what it means to have empathy for the entrepreneurial journey. And that doesn't mean that you have to be an operator before. You can have empathy for the entrepreneurial journey just by being in the trenches with entrepreneurs as they've been building. And so that's, I think, one of the most relevant things that I've gotten out of being an operator before is I understand that how hard it is to make sure in the early days you're meeting payroll every single pay period, how hard it is to make sure you're hiring the right people in the very early days. Because if you don't hire the right people, or you make the wrong decision about who you're going to work with as vendors, that can have serious impacts on the bottom line. And so there's some of those decisions I've been there with on the day to day that really help me, I think, when my entrepreneurs call me to throw around some ideas on what they're thinking about next.
I think you have a huge advantage as a former business builder and entrepreneur yourself. And I find that for myself as well, because I've built out ARI from nothing. It was just an idea in my
Right.
mind. And so it really differentiates me from other venture debt providers, because I'm not just a banker or a lender or a finance person, I've gone through 4 years, almost 5 years of building this from nothing and done the operations, the marketing, the team building, the HR, the risk management, the legal, everything, right?
Totally.
So I know how hard it is, and it's a painful journey. I think building a company, and as you know, if you talk to successful founders who have had exits and monetized their businesses, even then they wonder, was it all worth it sometimes? Because it's just so mentally and physically taxing when everything is on you all the time. And
Oh, it's the highest pressure. Totally. It's one of the highest pressure jobs you can ever have. I listened to your podcast with the rare breed venture, the rare breed roll up, and Dan, right?
Dan Espinal, yeah.
Dan. And you and Dan talked about that a lot, right? It's the grit that gets you up every single day whenever things look really, really tough, and what you're going to do with it. And I think sometimes entrepreneurs, tech CEOs or tech co-founders forget that a lot of VCs are entrepreneurs too, or a lot of capital providers are entrepreneurs, because I'm not the founder of Mercury, but my partner Blair Guru is, right? And he goes through that entrepreneurial journey still every single day when he's thinking about how we build a firm, and same with my other partners now here. So I think that it gets overlooked a lot, but we get it. We know what it's like to build firms.
Yeah, I've talked about this in the past. There's a book by Malcolm Gladwell where he talked about, he was at an event with a bunch of traders and military, senior military generals, essentially. And he said it was like two peas in a pod, because they're used to making risk decisions all day long, every day, and everything's on their shoulders. And I think I would add to that entrepreneurs, and I'd also add pro athletes. In my mind, those are four of the most stressful jobs. I was a bond trader on Wall Street at 60 Wall Street at Deutsche Bank. I helped manage a $25 billion portfolio at Sun Life, which is a $1 trillion asset manager. Those are stressful jobs, very stressful. And,
So stressful.
and I don't even think it compares at all to the stress of being a founder.
No, I have a different background, but I agree with you. I think the stress of being a founder is probably one of the most stressful jobs out there, because especially as you grow too, or even in the early days, say you've taken some friends and family capital, like your friends have trusted you with money. Like that is something that keeps people up at night, right? And early stage venture, like a lot of companies fail, and that's okay. But oftentimes friends and family don't know that when they're sure, Zach, I'll back you for your new tech idea. And they don't understand that they need to build a portfolio of assets. If you're going to do one early stage investing, you need to do others. And I think that just keeps entrepreneurs up at night. But the ones who get through that, and then you hire people, and then people's livelihoods depend on decisions you make every day. I mean, it's a very intense job.
Well, this is a perfect segue, because I want to talk about the funding markets right now for startups and the VC market. And it's a very, very tough environment. We're still in the first quarter of 24, and it doesn't seem like it's going to get better anytime soon. What are your thoughts on the current market?
It is undeniably a very tough market. And Zach, we've already talked about this. I think this is how we initially were bonding. But this is the tightest capital market by far in venture since like 2010. And that is not easy. And so for companies, I live in two worlds, because I'm an early stage investor. So that means I have some seed companies in my portfolio. And then I have some Series A that have kind of like hit scale and are growing into like the Series B growth rounds, et cetera. And so I see just such a stark contrast between those two kind of buckets of founders and what they're going through. And so generally, seed stage investing has largely evaporated, especially pre-seed, like very early. A lot of that has to do with, so emerging managers went out kind of in the last bull run, and emerging managers were really interested in investing in seed and pre-seed companies. So a lot of the emerging managers were super early stage. They were also diverse. So 80% of diverse managers were emerging managers in a report I saw in like 2021. And so that's a whole different dynamic, which we can get into later if we have time. But those funds are getting wiped out. Why? Because LPs are deciding where to continue to deploy capital, and they're deploying capital into fund managers that are proven and that they know. And it is a really sad kind of state of business for the venture industry. But I think what it really means for entrepreneurs is you have to know that there are a lot fewer dollars chasing a lot of deals still. So if you're thinking about starting a company, that's one thing to consider. If you're already in and you've raised the seed round or you've raised the Series A, something super important to remember in such a capital restricted environment, everybody's bar is just a lot higher. You get this, Zach. I know you get this, but all of our bars are significantly higher. So for example, one of the key things that we're focused on right now at Mercury in this capital environment is there are a lot of companies that went out and raised either a very large seed or a fairly moderate Series A in, like, let's say 2021. And so they got kind of exuberant valuations, and they're trying so hard to catch up to those valuations because growth investors are like, we're not giving you that valuation. They might have still amazing growth rates. They might have amazing retention. They might have some amazing fundamentals for a Series A investor. But the growth investors don't really care about that anymore, where they were coming down and they were looking at Series A companies or later Series A to early Series B. They're just not really doing that anymore. And so that's created this huge gap in the market where there's all these successful companies that definitely would have been defined as successful a few years ago that right now cannot get funding. And why can't they get funding is because the bar is just so much higher between what the growth investors B and above is what I mean by growth, but what they're looking for. And so there's this huge actual place in the market where Mercury is deploying dollars, and it's right there right now. So we're finding what we call mature A's, and they're great companies. They're highly de-risked compared to some of our other seed stage and early A companies. They have their go-to-market motion and they're rolling, but they're not getting capital, and especially not getting capital on any sort of attractive terms for the board and the company. And so we're willing to jump in and say, okay, let's tweak a few of these things. We're already growing. We already know we have product market fit. Let's tweak a few of the other things we need to, like, get our cohort data in line. And then once the markets start to open up, we're going to be super, super well positioned. So there are dollars still flowing, but it's just tough. So what we're telling entrepreneurs is control your own destiny, try to do super capital efficient business models and get to break even if you can. And also you have to run incredibly lean. Like, we don't know when the markets are opening up. Economists all have their ideas. But until then, make sure you control your own destiny. And so get to capital break even and cash flow break even and go from there.
I've been saying that for quite some time. I think a lot of people weren't really listening. You know, they wanted to believe that the market was going to get better and it was going to be easy to get capital again. I said, no, it's not going to happen. Listen, to your point, you have to control your own destiny because you do not know what's going to happen in a macro sense. There could be many events outside of your control, like the IPO market being shut. IPO volume's down 92% from 2021 to 23. It's literally like frozen, right? That's not any company's fault or decision to make. They have zero influence on that.
Yep.
But that basically means there's no exit opportunity into the public markets for any of the so-called unicorns. And so you've got a big backlog of all these companies that are going to have to stay private for a lot longer.
Yep.
Yet there's less capital to fund them as private companies as well. And this brings me to a question that we talked about a little bit offline, which is the state of dry powder in the industry. We hear a lot about how VCs have all this dry powder, and I think that might not be true in a sense. What's your take on it?
Yeah, it's totally not true. We've been shouting this from the rooftops for almost 2 years now, because a lot of entrepreneurs, so the way it kind of cascades, and you know this, Zach, but just want to kind of like make sure we're level setting with everyone, is IPO markets closed, right? And because IPO markets close, then it starts to trickle down through later stage investing to early stage investing when it comes to dollars flowed. Deal count's a little different. But as it starts to trickle down, so then growth investors, much later stage and growth investors, start to fill it first because then they don't have liquidity opportunities. So then they start to push it down. So then Series A investors start to fill it and they start to push it down, et cetera, et cetera. And it goes kind of down the line all the way to the pre-seed. And so what we've been saying, and I have to give all the credit to Aziz Galani, one of our partners here, he's been saying from the beginning, he's like, the dry powder is like not a real thing that founders can be counting on. And why is that? It's for many, many reasons. Sometimes LPs, just because they committed capital, doesn't necessarily mean they're going to follow through on capital, right? If also there are no companies that they are now deeming good as fund managers, people are okay just sitting on capital. if their LPs are aligned with that, or they're okay just not even calling capital from their LPs. So just because the dry capital is there doesn't mean it's going to be deployed, because they have to get to a point of liquidity. And if IPO markets are closed, it's kind of like the end all be all, it's not there anymore. And so it's just not, it's actually not flowing at all in the way that people do. I think I gave you a stat earlier. Let me find it. This is a Silicon Valley report, Silicon Valley Bank, all of our favorite bank, RIP, but they still
RIP. We love you.
RIP. Gives you an amazing opportunity, Zach. But they put out this macro report every single year, and the 2024 one actually has a headline that says dry powder. It's not as dry as you think. There's almost $300 billion of dry powder, not 30, $300 billion of dry powder. I don't have my glasses on. And then the amount that's being deployed is 100 billion. So there's a 200 billion gap of dry powder.
Got it. So the headlines read 300 billion of dry powder, and people read that and think, whoa, I should be able to get funding. But the reality is only a third of that's being put to work.
Yes.
And and so it's not all that it seems. And I think I'm seeing this a lot, just talking to founders looking for debt financing. I think a lot of them don't realize that the market is 180 degrees different than it was even just a year and a half ago, right?
Why do you think that?
I think that I've just noticed, I've always studied behavioral finance and kind of behavioral science. When I was a trader, when I was a portfolio manager of fixed income in the last like 10, 15 years. And I think that there's a lot going into it that's behavioral, in the sense that people do anchor to the past, right? It's hard to change someone's perceptions. If they've been living in an environment that's a certain way for a long time and things change, they might not actually recognize that change until much later. And, it's pretty clear in the financial markets that we've had a huge bull run, 13, 14 years now at this point. And so anybody who's built a company in the last 5 or 10 years has just had phenomenal opportunities to fund themselves very cheaply. Money was almost free. I mean, you could borrow money from SVB as a startup pre-revenue for 3%.
Yeah.
It's like laughable in hindsight, right? And on the equity side, you could go out and raise money with nothing but a pitch deck and a half-brained idea, because it had, some magic word in it, and everybody was kind of trying to chase, the hot, shiny object. And so,
which, by the way, fundamentally, we are not investors like that, which we can get into in a little bit.
I know, that's why I have you on. I don't talk to investors like that, because I think they're jokers.
Well, and I will say, in defense of some of my friends who are at funds that are more like that, it's not at all how we invest. It's not at all how our LPs want us to invest, right? It's why we make partners with people like you, Zach. But when historically that is what their funds have done to get returns, then that is what the fund managers are telling them to do. And so, for example, like you just said, if you're an entrepreneur who has built a company in the past 13 years, 15 years, you have a very different take on what it takes to get capital than entrepreneurs who built in the 2008 era. And so I think VC has a reckoning coming. Absolutely. Right. And I think a lot of that has to do with people have to understand that capital is getting tougher to find, and you have to actually do real diligence. And what does that mean? Right. Like, back to the fundamentals. So,
and you nailed it, in that not only do founders need to pivot in their expectations, but VCs do as well. The model that worked well when we were at a peak bull market with very cheap capital and abundant capital, that doesn't work anymore. So now you can't go out and invest in these growth ideas that are going to hit maybe 1 out of every 10 or 20 shots, right?
Right.
Now you need to invest in companies that can drive profitability quickly, and that have business models that work and that can sustain themselves, even if they don't have access to external funding going forward.
That's one of the really interesting things that will come out of the next few years, is which of the very large big name firms survive. A lot of them have never returned anything significant to LPs. They might be, the hot, sexy thing to go work for, but like never have returned that much capital to LPs. And I just don't think that's going to last forever. And so it's really about building a business as a VC manager. It's about building a business that's sustainable through cycles. And I think the through cycles piece has gotten very lost over the past decade.
Yeah, and what we're seeing now, as you know, is LPs in funds are asking for different metrics. They basically are saying, hey, I don't care about what this paper IRR is and our forward-looking IRR in a sense. I want to see DPI. I want to see distributions on my paid-in capital. Right? I want to see some cash. I want to see some results. And it doesn't need to be a 10x return, but I need to see something because I don't believe there's anything there. Right?
Yeah.
I mean, that's what they're saying. I don't believe there's anything there of value in many respects. And
sure.
and so it's interesting because we've seen a boom, of course, in secondaries, right? And secondary opportunities.
Mm-hmm.
And everybody's kind of like piling in there too. And I'm curious if do you guys do anything in that space?
We don't buy secondaries, but we sell secondaries. So we have a pretty interesting model, which our LPs, our institutional LPs especially, like really, really like. And so we drive for DPI. So when we went out to raise Fund 5, we're investing out of Fund 5 right now. We upsized Fund 5 to a $165 million fund from Fund 4, which was 100. And talking about upsizing a fund in this market is almost insanity, right? And we did it. I mean, we did close early last year, but with that being said, it's because we had high DPI, higher than anyone else out there trying to raise. And then we're okay. The reason that we have high DPI is because we're okay if one of our companies gets bought by a massive company or a very like kind of Silicon Valley darling type of tech company, then we're okay selling some of our stock, getting like, let's say a 3x on it, like something good, but not exponential, getting a 3x on it, and then keeping the rest to let it ride. And so we will sell secondaries in some of these transactions to get to at least a 3x return on investment. So we'll get that cash, we'll return it directly to LPs, and then we'll wait the rest to let it ride so that we can get those outsized returns. And that's working really, really well for us. And so that's why we were able, I mean, it kind of speaks for itself and what we're able to do for Fund 5.
You know what I call that? Sound portfolio management. It's something that you'd see a lot in some of the bigger institutional investors, not in the VC space, but in the stock and bond markets, where they actually know how to construct and manage a portfolio. And what you guys are doing, definitely is similar in that sense.
I do.
But also keeping some of that upside so you can ride the winners as well.
For sure. I mean, I will say it kind of speaks for itself. And not trying to say this to like pat our own backs, but it's because we've been shouting this from the rooftops for a long time and it's finally like coming to fruition. So it feels good to talk about, but our Fund 4 is in the top decile of all funds of our vintage year. And it's because we just practice good portfolio management, right?
Yeah, I think you should shout it out. I think it's funny when people have been saying things for a long time and everybody doubts them and then they're right. And then everybody's like, oh, well, don't tell us that you were right. Like you're a jerk if you do that. I'm like, hey, private credit I knew was coming. Venture debt I knew was coming.
Right.
Everything we're seeing in the market, AI. Why do you think I named my fund Applied Real Intelligence, ARI? Right? It's like I've been on this for 5 years, and people just talk shit about me, right? Like doubted me for 5 years, and now they're like, "Oh, you're not allowed to tell everybody that you were right on all your calls." Like when I was like go long private credit in 2021, and I sent that out to like all the major pensions, and most of them never did anything with it.
Yeah.
And their returns, and they're like, oh, I would have made literally 40 points more in those 2 years if I had read that paper and done anything about it, because public fixed income got smashed in 2022. It was down to like 20-25% depending on duration. Mm-hmm. And meanwhile, private direct loans, the stuff that I'm doing and other direct lenders are doing, was up like 15-20%. So imagine that difference where you're literally clipping 40 points in a year in fixed income. That's a decade of returns. And so, I'm going to tell everybody I was right, and I think you should too. Yes, you have a freaking good fund. You're killing it because you have better processes than your competitors. So,
yeah. Well, thanks. Okay. Well, here we go. Shouted it from the rooftops on the
exactly.
7x7 podcast.
We were right. We would have made you a lot of money if you were invested with us.
Right. Right.
So Sam, taking a half step back, now that we've patted ourselves on the back, and developed a couple more haters out there, um, let's talk about timeless principles of investing. So let's talk about key investment principles that you live by, and it could be principles or processes. And I know that what you do, the stage that you invest in, is much earlier than most people listening will be investing in. And so it's much more qualitative,
For
much
sure.
more geared towards the people. So explain what you do to identify the best opportunities, and then also the processes that you implement along the way.
Yeah, we actually have a pretty good process that I'm proud of because we've worked really hard on getting here. And so every year or every change of cycle, if it's in the middle of the year, we all get together and we do a full offsite and we just throw up on the board what are the things that are the most important to us as senior partners of the firm. We throw it up and then we all force rank them. And we think about what are the most important things to be investing in right now that are relevant to this current macro environment and relevant to when we think in this scenario, like when we think liquidity markets are going to open back up. And so we call that kind of our fundamentals. And so that's what we really drive into there, which is more the quantitative metrics, right? Those are growth rate, retention, the high metrics we know that Series B investors and beyond, all the way up to public markets, usually really care about. Those are, the capital efficiency of the business model all kind of boil down into that managed with the growth rate. And so we have like pretty strict metrics under there that we're investing on right now in these A companies that we're finding. But I think oftentimes, especially this happens when later stage investors start coming a little earlier, what they miss is that there is undoubtedly a qualitative perspective here. And you have to have one, and you have to have high conviction in what your qualitative perspective is so that you're attracting the right entrepreneurs. Because so we take lead investment stakes. And so we're investing like the majority of the round in A's, and then we jump in on the board. And as needed, we're like very, very hands-on with the company. Zack, that's how I met you, right? Through one of my companies. And so we're very hands-on with them. And so there's this qualitative piece of one, making sure kind of the founder VC fit. A lot of people talk about that, but what does that mean? It means something very different for us than it sometimes means for others. But that dynamic and understanding like why that founder wakes up every single day to drive this, because early stage investing, especially series seed and A, it's tough. We already covered that, right? We've already covered that a lot here. It's really, really hard. And so you have to really understand, why is this founder so passionate about the problem they're solving? And then are they going to keep going? When they are staring at a wall, are they going to figure out how to get through the wall? Right? Because there are going to be so many walls, so many hurdles that they're going to have to jump over. And you really need to understand that. And so it's like really digging into the grit. I think you and Dan covered this too when you were talking about some of the military background, right? Like you have to understand their grit, and you have to understand how they scale that wall, how they get around the wall, because plenty are going to be thrown up. That one's super important when it comes to founders. And then we also kind of have to force rank some other qualities about the founders, and that's highly qualitative, right? And so you have the vision, you have the scalability. Can they scale, right? Are they hiring the right type of people that know how to scale these type of businesses? The coachability, which I actually hate the word coachability, but to me it means something like that I can easily define, and it means something different like to probably every single person, but to me it means collaborative problem solving. And so is this founder, is the CEO open to collaborative problem solving? Because if they're not going to attract the right people, they're not going to attract the right investors, and then they're trying to do it alone, right? And then finally, self-awareness of the founder, like where are your gaps and how do you hire around them? When are you no longer maybe the right person to be the CEO of the company, if we ever get to that point? And them actually bringing those things up, I think is a really, really good sign that we look at when we're kind of looking at the qualitative measurement of a founder.
What would you say are the 3 to 5 most important qualitative aspects, and how do you quantify something that inherently can't really be easily quantified? In other words,
Yes.
you're looking at their footprint in life, right, to see what they've done in the past, but are there other ways to determine what their kind of core personality traits are?
People are trying. We've had very robust, fun discussions about this at Mercury, because I will even say, like, in full transparency, like, we're not even aligned yet on being able to assign kind of a quantitative value to the qualitative metrics we're trying to diligence founders on. And so we are working with a behavioral psychologist, though, who really understands venture, to try to put some sort of framework around it. And the biggest part of that is not so that we get an outcomes report that decides whether we invest in the founder or not. It's not as much about that. It's about, from that outcomes report, then we all decide, how do we work best with this founder? Like, if there's red flags, there's red flags, but usually we can get those, right, from like just conversations. And it's, do you have a lot of turnover in your executive team? Do you not recruit like top talent? A lot of the things on how they work with people, and then how they're transparent and open in the diligence process.
So I've got to mention something talking about transparency and diligence.
Yeah.
We were talking before offline about how I'm writing an article now for founders about how to avoid the startup death spiral. In other words, if they're valuation craters and they need to go raise capital to survive, how do they get to the front of the line, right? How do you stand out? Aside from their business fundamentals, are there other little things they can do that actually become big things in the process? And you just hit on one, which is in the diligence process or in the conversations, they need to be transparent and truthful and fair in their actions, and aligned with you, demonstrating alignment with the VCs and with other stakeholders. I think they need to be so I have a list that and I'm working on this article now, and it'll be out in March. I'm actually starting a new monthly column where I'm writing for the benefit of founders and entrepreneurs to help them get over a lot of these typical blockages and pain points that everybody experiences. And one of them is how do you stand out in a competitive process? And it's not just about your company. I think it really, for me, a big part of it boils down to, do I trust this person and this team? And there's that. It's actually funny to me how people expose themselves by being liars or being very
Trying to hide the ball.
Yeah.
I think that's, we have to figure out, are they lying on purpose, or are they trying to hide the ball because they feel like they are so desperate to get this capital in? And either one is not a good thing. Right? Mm-hmm. But it's interesting because there's a lot of things that are very, very hard to uncover in diligence that shouldn't be hard, because the point is, we're investing in people who we want to partner with, Zach. Like, you're going to partner with your entrepreneurs, just like I'm going to partner with my entrepreneurs. Like, the only way we can solve problems is if we know what the problems are. Mm-hmm. And I think one of the really important things that often gets overlooked is that the narrative is very, very important. So, for example, I talked to an entrepreneur yesterday. I've known her for over a year. She's done a few different things over this year. And sometimes it was trying to raise on a higher valuation because they have like a very, very deep tech platform that was getting valued probably in 2021 at something that she was trying to raise on in 2023. It didn't work. So then she pivoted, and then she kind of buckled down and figured out, how can I prove out some traction? And then she brought the valuation down, and then she came back. And she is not trying to hide the fact that she did that. She was like, no, it made sense. The market changed. And then I talked to all of these experts in the space, and they helped me craft what is now the best thing for us to do as a company. And she wasn't hiding the ball. She was just like, we tried to raise on a higher valuation, it didn't work. And here's why it didn't work. And this is what we did to fix it since a year ago. And now this is what we're doing. And like, I just appreciated it so much. It was so refreshing. I was like, thank you. Thank you for just like reminding me, so that I didn't have to go back to old emails and pull it up and look it up myself and then ask her about it, right? In 2020 or 2021, you could raise money on a deck. You can raise money at exuberant valuations on a deck if your idea was good enough and your team was good enough. And like, that's just not the case anymore. So people need to remember that for sure as they're building out their pitch decks.
So just to wrap up this point, in terms of things that founders can do, to put their best foot forward, I'll name a couple, and then I want to hear a couple from you. So I would say be transparent, be fair, be accessible, right? If your VC or potential funder is emailing you and it takes you a week to get back to them, they're not going to chase you. Like, this is not 2021. Like, they're not going to chase you. They're going to forget about you, put you on the do not call list, right? be responsive, right? Like get back to people quickly. And I think, be humble is very important. Every founder needs to be inherently a huge believer in themselves, and by definition, be an overconfident individual. Because
Yes.
otherwise, you would never start a firm, because the numbers would tell you otherwise. They'd say, don't start a firm because most fail. So you have to be a little bit crazy, and you have to be a lot overconfident, right, to start a firm. So I don't mind people that have tremendous confidence. In fact, that's something I look for. Like, I'm sorry, I don't want the person, with my money not having confidence and thinking they can, they said they're going to do. Like, save humility for something else in many respects, but be humble in other ways, right? Like, know that you're going to go and drive this business forward, but be humble in how you interact with people that are trying to partner with you, right? Like, they can partner with anybody else too.
Yep.
But those are some of mine. What are some of yours?
Yeah, I could sum up that. I call that being unabashedly bold, right? So like you have to understand that piece, because that is a special sauce for a entrepreneur. And then we actually force rank this in the top things we look for, and it is in like the top 5 for Mercury, going back to kind of qualitative assessment on things, is unique insight. What is your unique insight into this market, or into how this tech applies to the market, or into your customer's mindset, or whatever it is? But what is your unique insight that positions you and the company to win in this market? And being able to really fundamentally understand that, and then be able to explain to people that in a very like concise way, is a superpower. And founders that have that are able to raise a lot of money at higher valuations, pending the rest of the business works. But that I think is super, super important. So I'm going to say unique insight. I'm going to say the boldness, vision, of course, but vision kind of goes into that unique insight. I mentioned this earlier, but proven ability to scale. And that doesn't mean that you brought a company from 0 to 10 million ARR always. It can mean you know how to put the right people around you that know how to scale if you don't have that experience. And then, yeah, I mean, I think probably the most important thing out of all this, but it kind of encompasses everything we've said, Zach, is self-awareness.
Good
And
one.
so how are you self-aware as an entrepreneur and as a CEO? Because it's a very lonely job to be a CEO, as you know. And so like, how are you so self-aware that you're going to continue to question yourself, and what you're good at, where your skill sets best are, and then how you kind of build a team around that? So
Those are great. Those are very good. So, question for you now about how you source investments. And this is a question I get all the time from prospective investors. And they say, hey, yeah, we love your process. You've got probably the best processes we've ever seen, quite frankly, because you've developed them at 3 different $1 trillion shops and have 20 years doing this. But process doesn't mean anything if you can't source the investment, right? So that's
right.
the key point, right? What I will say for venture debt, and it's probably even more true for venture equity, is the investment process is the easy part. It really is.
But people get it so wrong, but you're
Yes.
right. You're right.
The hard part is, how do you identify the right opportunities? And especially on the equity side, where it gets really crowded and it's hard to get into the opportunities that are perceived to be the best. How do you find those companies? But also, forget the super hot companies. I always think those that wind up being a bad trade most of the time.
Yeah.
How do you find the companies that are maybe not on other people's radar, but that wind up being solid producers and sometimes big winners?
Oh yeah. I mean, this is a very like Mercury in our DNA thing, and people kind of look at us like we're crazy. But we're not afraid to look in places no one else is looking. So that's one of our big, big differentiators. We have other things that other venture funds have. For example, we run one of the largest software conferences in outside of the coasts here in Texas. We do it every 18 months. It's called the CXO Summit. So we do that. That brings a lot of entrepreneurs and a lot of funders into a room together. We network with all the seed stage VC firms. We network with growth investors so that they know what to send us. So all of that, that's just what everyone does and what you should be doing. One of the key things that we do, and it's actually proven out to be very, very successful for us, is we'll go into markets where no one else is. And especially if we have LPs there. So for example, we have a big LP in Tulsa, Oklahoma. And guess who the largest, biggest VC is in Oklahoma? It's us, by dollar. And why is that? Because we have an LP there. So then we started understanding the Oklahoma landscape and the Tulsa landscape. We've invested in 3 companies out of Tulsa, and all of them are some of our top performing companies across Fund 4 and Fund 5 right now. And what I think is interesting about that specific example is that when you go to Tulsa, entrepreneurs, or anywhere, Houston even, right? That doesn't have like a huge ecosystem. When you go to these places that aren't flush with capital and aren't flush with ego, is a big part of it, right? Then you can find entrepreneurs who understand fundamentals of the business, how you drive cash flow, how you make sure your business sustains through ups and downs of market cycles. You find people who are just a little bit more conscious of that because their peers around them are running those types of businesses. And so the flip side of that is then sometimes it's hard to get them to go into like full growth mode when it's time. It's like, okay, we know we have the capital, we know we have the metrics, go into full growth mode. And they're like, but cash flow break even. And it's like, yes, that's good. But now how do we balance that with growth? And like, that's a conversation now at a much later stage than we used to have in the earlier investment stages of the companies. But that's, I think, a good example. Like, we'll go where other people won't go because you can find good startups literally anywhere. You really can.
I couldn't have said it better. I mean, that's exactly how I think about it. And it's true for any market. You have to go where others don't go, and you have to think differently.
Yep.
Otherwise, you're going to get average returns at best, because if you're thinking like everybody else and you're chasing all the same deals they are, you're going to be average. And average is okay when the markets are up 20% or 30%. It's not okay when the market's down, right?
I love it.
And so, to your point too, I think a lot about where are there gaps, right? Where are there gaps within the gap, so to speak? So in venture debt, for instance, the market's already underserved, and there's definitely a funding gap there. In other words, there's a lot more demand for venture debt right now from founders and startups than there is available supply from banks and non-bank lenders. So there's already a big gap, which presents a huge opportunity if you're a venture lender with dry powder and a clean balance sheet like us, right? However, within that gap, there are even greater opportunities. So the gaps within the gap. And so you already nailed one, which is geography. I think that's, without a doubt, a great place to start, because if you look outside of the Bay Area, New York, Boston, and LA, there's really like not that much activity in all the other cities. And of course, people say, well, Austin and Seattle and a couple others. And it's like, but there's still a fraction of what the big four are doing, right? And then you take it down one more notch to the Tulsas of the world, and no one in the world is calling on them. You have 100% market share in the good startups in Tulsa because nobody else called on them, right? And so that's low-hanging fruit. That's alpha generation opportunity, right? You can outperform simply by going to a market that nobody's in. And then on top of that, I really like looking at sectors and business models that are not hot, right? Everybody's scared of like consumer right now, right? And there's valid reasons for that, but everybody goes through these cycles of emotions where something's hot today and it's not tomorrow. Like, they love AI today, they're not going to love it when they lose all their money in most of these investments in 5 years, right? And so that cycle presents opportunities, because if you take the best performer in a segment that nobody else is calling on, that is so much more valuable than taking the number 100 SaaS company that everybody's calling on. It's like, it doesn't have a differentiated model. That's not doing anything interesting. That's totally really commoditized in many respects, right? And so I think there's that. And then I also think founder type matters, in the sense that women, Blacks, Hispanics, veterans, they are completely underserved and don't have the same access to the markets that their ideas and execution capabilities deserve or warrant, right? And so if you are somebody who calls on them and you want to partner with them, and you make capital and ideas accessible to them, now all of a sudden you're touching 75% of the US that nobody else is even calling on.
Yeah, which has massive, massive market opportunity, because, as I just told you, Zach, I'm 5 months postpartum right? And what I realized was, wow, this is an entirely underserved market from a tech perspective. I'm used to using tech for literally everything, checking my bank account all the way through like how I decide what groceries I'm going to buy and put in my refrigerator. And so there's like very little out there for childbearing parents. That's crazy to me. I'm like, oh, why is it? It makes a lot of sense because only 2% of women get funded, and they're the ones who have lived through this. They understand the customer journey more deeply than anyone else, and they're not getting funding. So then why are they going to start that company, right? And I think that that is just one example of many when we think about how we fund underrepresented entrepreneurs. And I will make a plug here on Mercury because when I joined Mercury in 2020, I looked at Blair, who's the managing director here, co-founder and a managing director here at Mercury. And we had real conversations about how we're driving diversity in the pipeline, right? And not only in the pipeline, but then how that's translating to diversity in our portfolio. And he told me, he looked me in the eye before I was even fully onboarded here. And he said, if your worldview is woven through every single thing that we do when we think about our pipeline metrics and our diversity metrics across, then we know we're successful. And so it's not saying that my worldview is correct, but it's saying inviting that type of conversation to be had at the highest levels is a way how we think about underrepresented entrepreneurs. And so underrepresented entrepreneurs are in Tulsa. We've always been looking at underrepresented geos. And so it was a fairly natural opening for us to also be thinking about underrepresented entrepreneurs. So that's something that we track very diligently and we hold each other accountable on also.
And you know what you hit on, and I want to amplify this. These groups are consumers too.
Mm-hmm.
And that's what you nailed when you're talking about the product that you just mentioned, right? There's a huge percentage of the US, roughly 75%, that are consumers.
Yep.
And they have unique needs because different types of people have different needs. The needs of a middle-aged man are very different than the needs of a young mother, for instance, right? It's very, very different. If you look at every segment, they're very different in what they need. And a lot of times, because to your point, there's not enough founders and VCs that come from those groups, because there's not very many VCs either that are women or minorities or veterans, right? It's a very small group. And so there's not a lot of VCs and there's not a lot of founders, but yet it's 75% of the population consuming every day. And so to really understand what those groups need, though, you need to have people from those groups, identifying those opportunities. And so that's what I think people miss. This is not about like, hey, this is like, let's give money to somebody because of their race, gender, ethnicity, or sexual orientation. Like, it's not about that.
No.
It's about serving customers and making money, right?
Yes.
And they're not being served, and therefore there's a lot of money not being made, right?
For sure. And that's what I think we also have an additional thought to that, Zach, that it's not just on the entrepreneurs you fund, but it's about the LPs you bring in to our fund. And so we're hyper focused on that. So Heath Butler, who's a partner here at Mercury as well, and he's actually my mentor through Kauffman Fellows, which is awesome. Heath is just so great. But before he started at Mercury, he started something called the Urban Capital Network. And the entire idea was to lower the barrier of entry for alternative assets, for people of underrepresented people to invest in alternative assets. And so Urban Capital Network has spoken to Biden. They've been at the White House. They kind of go like they are well known now for doing this. And their entire idea is to match up with venture funds, partner up with venture funds that are doing de-risked investing, so a little bit later, so doing Series A, Series B, and beyond, and then investing alongside them on their best deals. And so the way that they kind of all think about it is that by recycling capital back into these communities, then that's going to foster innovation in and of itself, and it's going to foster the first kind of like startup capital checks that people need to get their companies off the ground. And so it's really like it's a whole ecosystem. So capital needs to flow into those communities. People need to be have access to those capital and the resources so that they can start the companies. They need access to capital and resources as they grow their company from people like ARI from people like Mercury, and then they need access to the customers who are going to be buying, and then they need to recycle that capital back into the ecosystem. So it's really like a whole ecosystem that we think about here.